The pin bar is without a doubt one of the most powerful and reliable price action trading signals that can be traded across many different markets and time frames. The beauty of using a pin bar is that they form often and they appear on all time frames, showing a simple approach to technical analysis. The main advantage of using a pin bar trading strategy is its simplicity. Nowadays, traders use sophisticated trading strategies to come up with less productive trades. You don't have to do that when you are trading a pin bar. You just need to read price action. Today we'll talk about one of my favorite candlestick formations, the pin bar, and I'll show you how to correctly identify them in order to increase your winning ratio. If you're new here, make sure you subscribe and click the bell icon to enable notifications, and also leave us a like to show your support. A pin bar is a price action pattern which signals that a reversal may be about to take place in the market. The great thing about pin bars, and the reason I prefer them, is the fact they are really easy to spot on your charts. There can be no confusion as whether the candle you are looking at is a pin bar or a different type of candlestick. Let's take a look at what pin bars are supposed to look like when they are formed on your charts. This is a simple example of a bearish pin bar. Notice how the body is found at the bottom of the candlestick, and the long wick is found at the top. All bearish pin bars you'll see form in the market will follow this basic structure. They all have their body at the bottom candlestick and their wick at the top. Sometimes the body of the candle will not be found right at the bottom, like you see in this chart, but it will always be found in the bottom half of the candlestick. Here we have a bullish pin bar. As you can see, bullish pin bars look very similar to bearish ones. The only real difference between the two is the body of the bullish pin bar is found at the top of the candle instead of the bottom, and most of the wick is found at the bottom instead of the top. Similar to the previous example, the body of this bullish pin bar doesn't manage to close right at the top of the candle, but like I said before, this doesn't make a difference. It's still a bullish pin bar and should be treated the same as all other bullish pin bars you see form in the market. Now, here comes the missing piece of puzzle and the reason why many traders fail to trade them correctly. How to make sure it's a pin bar? Simply knowing that the body of the candlestick needs to close towards the bottom or the top of the candle in order to be a bullish or a bearish pin bar is a bit of incomplete advice, especially for new traders who have little experience identifying pin bars in the market. I consider a valid pin bar a candle that meets three conditions: the open and close within previous bar, the wick is minimum 3 times the length of the body, and the wick must stick out from all other candles and must be very obvious. Here's the common mistake among traders. They don't know how to correctly identify pin bars. The less well-defined pin bars and smaller pin bars are generally the trades you don't want to be trading. The rules for a pin bar are straightforward. The price opens and closes within the previous candle. The wick should be 3 times the length of the body, and the wick itself must stick out from all candles. Here are a few examples of valid pin bars. Another important thing is the fact that pin bar is a reversal signal and not a continuation. A major reason why many traders lose money over and over again trading pin bars is because they try to trade the pin bar as a continuation signal. To trade a pin bar as a reversal, it means we have to pick the price to reverse and form swing points. If we want to trade a bearish pin bar and anticipate the price to move lower, we first need to see price moving higher, so we can pick price to reverse. We can't play a bearish pin bar reversal signal if the price has not first moved higher. Notice in this example how price first moves higher, and after this the price forms a bearish pin bar. Here's an example of what not to do. In this chart, the pin bar is traded as a continuation rather than a reversal, as all pin bars should be. This pin bar is a bearish pin bar, but the pin has not been traded after the price made a move higher. This pin bar has been traded to see if the price can continue to move lower. If you decide to trade this pin bar, you will be selling low and hoping to buy back even lower, which is the wrong approach. The number one rule in trading and investing is buy low and sell high. Trading pin bars as a continuation means you buy high and hope to sell even higher, or sell low and buy even lower. It might work in some cases, but the high probability trade is to treat pin bars as reversal signals. Trading pin bars from incorrect areas on the chart is another big problem, which is getting traders into trouble. You cannot enter a trade just because you see a valid pin bar. The pin bar has a higher chance of reversal if it occurs at a strong area of support or resistance. Pay attention at this chart. You will notice that it has two pin bars. The major problem of trading these pin bars is the fact that there is no room. You are trading straight back into the recent high, which represents the near-term resistance. As you can see on this chart, this resistance held and pushed price lower. Trading pin bar signals with support and resistance confirmation is perhaps one of the most effective ways to trade. When combined with a strong support or resistance level, pin bars can be one of the most accurate trading signals available. The best pin bar setups occur near confluent levels of previous price action, as the market moves in one direction and then regresses back to retest the previous support or resistance level. We can see in this chart two successive pin bar testing a previous support and resistance level, and then resuming downward momentum. The more confluence you can combine with a pin bar signal, the higher its accuracy becomes. In this example, we are looking at a bearish pin bar sell signal that formed in the context of a downtrending market and formed at the confluent area in the market. The confluence between the dynamic moving average resistance zone, the horizontal resistance, and the downtrend gave a lot of weight to the pin bar signal. When we get well-defined pin bars like this, that has formed at a confluent area or a level in the market like this, it's a very high probability setup. And here's another important tip. The very best pin bars stick out. They are not hidden in your charts. A big misconception with new traders is the fact they want to find the smallest pin bars they can, because it will offer them the smallest stop and the biggest risk reward. This is completely wrong. The bigger the rejection and the bigger the pin bar, the more powerful the signal. The best pin bars are large and obvious candles that, as soon as you flick over to your charts, you will notice them. These are the pin bars that stick out and are practically screaming at you to trade them. All good pin bars need to have their wicks sticking out from all candles, and if they don't, then they don't fit the basic criteria I've talked about. This chart is a great example of a pin bar that sticks out from all other candles. First, notice how it opens and closes within the previous candle, and then notice how the price has moved higher before forming the pin bar. This pin bar is being played as a reversal, and it has space to move down. The really great thing about pin bars is the variety of different ways in how you can trade them. In this video, we've talked about the basics of pin bars, but in the next ones, we'll go even deeper and I'll show you how to trade with them, how to find the best areas to trade them, how to set up stop losses, and how to establish take profit targets. As always, if you learned something new, make sure you subscribe, click the notification icon, and leave us a like to show your support. Until next time.